Hi, I'm Ryan Perry, Senior Associate on the Acquisitions team here at RREAF Holdings. Welcome to this session of RREAF Academy, where I'll be walking you through our acquisition process and how we approach evaluating new investment opportunities. Today, my goal is to give you a clear, behind-the-scenes look at how we analyze deals, from reviewing prior ownership financials to building out a tailored RREAF business plan that aligns with our vision for the community. Whether you're new to multifamily or looking to deepen your understanding, this session is designed to give you a practical overview of how we think and operate. Let's dive in. Hi, I'm Ryan Perry, and I'm a Senior Associate on the Acquisitions team here at RREAF. And today I'm going to take you through a platform overview of our multifamily acquisitions team. We're gonna talk about a lot today. Hopefully I'm gonna take you all the way from sourcing a deal to closing a deal. So first is sourcing the deal. There are really three different ways that we source deals here at RREAF. The first being fully marketed deals. These are deals that a seller goes to a brokerage like Cushman & Wakefield, CBRE, Colliers, just to name a few, and they tell them that they want to sell the deal, and those brokerages put together marketing materials that they end up sending out to somewhere between 100 and 500 groups. Those deals are seen by a lot of people and they're very competitive. So typically, we like to stay away from those deals because we find it hard to find value in deals that have been bid up maybe above what we think the value is. The next is off-market deals, which is where we here at RREAF source the majority of our deals. This process is also run through a brokerage shop, but it is done when a seller wants to do a smaller marketing process or maybe acquire a marketing process that flies more under the radar. So they'll go to a brokerage shop like we discussed before, and they'll tell them, hey, I want you to bring this to 10 groups that you know can close this deal and it fits their buy box, and we just want to do this quietly, so we want you to bring it to a very small group. Now this is where RREAF's reputation in the market really helps us out, because when deals like this that are going to have a lot less competition and are transacted on off market are brought to us because we have great relationships with our brokers. They know we can close, they know that we stick to our word, and we get a lot of value through that process. The final and the hardest is direct from sellers. And this is mostly relationship driven. So getting a deal direct from the seller where you completely cut out the brokerage and you're the only one looking at the deal is typically where you're gonna find the best value and be able to acquire a deal for the lowest price. But it's also the hardest to do because it's the least common. This is usually done with a group that you've previously transacted with in the past, and that is how the relationship is established. Next is the financial overview of the deal. Whenever we get a deal into the shop, it usually comes with what we just broadly call the financials, and that's made up of rent rolls, T12s, tax bills, lease trade out reports, age receivable reports, and rentable items directory. So the first is rent rolls, and this really breaks down who lives at the property, how long are they going to live there, how long have they lived there, and what are they paying. The next is T12 operating statements. This breaks down every income line item and every expense line item at the property, and it tells us how much money is being produced or collected from the tenants. What are the expenses? And then ultimately, what's left over? What is the net operating income? Next is the tax bills. A lot like residential homes, we have to pay real estate taxes on all of our properties. So we like to look at how much is owed in property taxes. And we also like to look at how the property taxes changed in the past 5 years, because that helps us figure out how we think they're gonna change over the next 5 years or 10 years. Next is lease trade out reports. So this tells us whether or not there are a lot of renewals at the property, whether tenants are staying year over year, or if we're signing a lot of new leases with new residents who didn't previously live there. And it also tells us how are the rents increasing or decreasing as we move new people in or renew new tenants or renew existing tenants. Next is the age receivables report. And this really just tells us, are people paying rent? And if they aren't paying rent, have they not paid rent in 30 days, 60 days, 90 days? It helps us keep track of the collections of the property. And finally, the rentable items directory. This isn't applicable on every deal, but it will give us a breakdown. It's a lot like a rent roll. It gives us a breakdown of any carports at the property, any storage units at the property, any detached garages, who's occupying those and how much are they paying, and how long are they going to be occupying those rentable items. This is a screenshot from a T12. You can see that we have a lot of line items like our rents, our garage income. So these are all income line items. If we scrolled further down, you'd get to the expenses where we break down things like repairs and maintenance, payroll, taxes, insurance. This one is from July of 2023 all the way to June of 2024. So you get 12 months of information on how the property is performing from a financial basis. Next is the rent roll. So moving left to right, you can see that we have our unit number, the unit type, the square footage of the unit, and then the resident name, which I have blacked out, or the vacancy status. And then you have your actual rent being collected, your move-in date, your lease expiration date, and then, if applicable, the move-out date. So you can see down here that we have a couple of residents who are planning to move out. The reason that the lease expiration date isn't the same as the move-out date on some of these is because we typically don't know if a resident is going to move out until 60 days before their lease expiration date. For example, this lease expires October 28th, 2024. So 60 days before that, we'd reach out to the tenant and say, hey, would you like to renew? This is the proposed rent that we would like to renew your lease at. And at that point, they have the option to either tell us yes or no. And if they say, no, I'm not gonna be living here anymore, we would update their move-out date to be 10/28/2024. Next is our age receivables report. So like I mentioned, this just tells us, are people paying rent? And also, are they prepaying rent? You can see right here in the total unpaid charges, we have zeros, we have positive numbers, and we have negative numbers. What the negative numbers mean are prepaid rents, which we love. It's really just the positive numbers that we're looking for, which means they're delinquent on their rent. They haven't paid it. Moving left to right, we have a 0 to 30 days column, a 31 to 60 days column, a 61 to 90 days column, and an over 90 days column. 0 to 30 days is where you see the most what we call bad debt or unpaid rents. When it's 0 to 30 days, it's not a ton of concern for us, because some people just get paid on a different cycle. Maybe they'll be late on their rent, but once they get their next paycheck, they're gonna pay us. It's really once we get to the 31 plus days that we start having to look into whether or not we think we're gonna be able to collect rents from the tenant moving forward and make that decision on whether or not we think we might have to evict the tenant. Here's a lease trade out report. You can see there are two different sections here. The top one being new leases and the bottom one being renewed leases. So new leases meaning someone who didn't previously live at the property is moving in, and renewed leases meaning someone who already lives there has renewed their lease for another year. For the new leases, you have the rate that they're set to pay, their lease sign date, their move-in date, and then over there you have the former lease rate, which means what the prior tenant was paying. What we like to look at is how does that former lease rate compare to the new lease rate. On this specific lease, we had a $100 decrease. We had a $20 increase here and a $20 increase here, another $100 decrease here. So we like to look at this, and it really gives us a good idea of, are the rents at the property trending up or are they trending down? And here's our rentable items directory. So you can see at this specific property, we have some garages and some storage. We have our resident name here that I've blacked out again, when they started leasing the storage or garage, whatever is applicable, the occupancy status, and then what they're paying. Here's a tax bill. This is actually a tax bill from Chatham County, one of our assets there. So on a tax bill, there are really three main things you want to look at. The first is, some people call it fair market value, some people call it appraised value. And essentially that's when the county sends someone out to appraise the property and figure out what they think it's worth. Some states are all on different cycles on when they reappraise the property. Like Texas reappraises every year. North Carolina reappraises every 4 years. Just with all the work that we do throughout the markets we work in, we've learned all of the different tax nuances and make sure that we include that in our underwriting. We also have a great team of tax consultants that we work with as we get closer to acquisition to make sure that we're underwriting the taxes all correctly. So we start with appraised value, we apply an assessment ratio, and now we have our assessed value. Some places it's 5%, some places it's 100%. It's just different county to county. So your assessed value is your taxable value. And once you have your taxable value, you have what's called a millage rate, and that's just a fancy word for a tax rate. In this specific county, you can see that we have just 3 line items of taxes. Sometimes you have a lot of them. Typically, you're paying taxes on the school district, your utility district, things like that. You take your assessed value and you multiply it by the millage rate, and that gives you the amount of taxes that you're paying. If we are buying a deal in 2025, we want to look all the way back to 2020 to see how the taxes have changed since then. And then that'll help us assess how we think the taxes are going to change over the next 5 years from 2025 to 2030. Underwriting. All the financials that we just discussed, the first step of our underwriting process is that we're going to import the rent roll and the T12 into our model. And that will help us get a good baseline of how the property is operating right now. Then we'll engage our tax consultants and layer in what we think the future taxes are going to be on the property for our 5-year or 3-year hold period. Next, we build in the value add plan, which is really our business plan for the asset. It's how we are going to add value to the property, how we're going to make it a better place to stay, and create good returns for our investors. The first thing we're going to do is build out a renovation plan, if applicable. Typically, RREAF, we buy value add product, but if we bought an asset that was built in 2025, we're not going to renovate a brand new product. If we're buying stuff that's more, 10 to 20 years old, that's when we're going to apply that value add plan. What we do is we build out the cost of renovation. Are we going to replace the countertops with granite countertops? Are we going to put in new cabinets, new fixtures? All of that goes into our renovation budget. And then we look at the rent comps, the properties around, and we figure out how much do we think we can charge for a premium for this upgraded unit. Next, we adjust the expenses to reflect the new ownership, our ownership, RREAF's ownership. We will look closely at the T12 and figure out how do we think current ownership is doing operating this property. Some owners, we see that they're spending way too much on payroll or repairs and maintenance, and we think that we can adjust that down. In other situations, we think that other groups are spending way too little on their payroll and they're understaffed. We'll work closely with both RR Living, our property management team, and our asset management team to make sure that we think our expenses are in line with how we can operate the property. The other thing that's great about RREAF is we have an existing portfolio of a lot of assets, and we're typically buying in markets that we already own. So what we like to do is if we already own an asset in the area, we'll look at that asset, we'll figure out what are we paying for payroll there. It gives you a pretty good idea that if this similar asset just 5 miles down the road is paying $1,700 a unit in payroll, we know that this other asset that's very similar and very close in the same market is going to have a similar expense line item. So that helps us with our underwriting process. Next is the additional income. We're going to reference our rentable items directory there, and then maybe we are going to add washer dryers to every unit. If we're going to charge $40 a month to our tenants for the upgrade of having a washer and dryer in their unit, that's where we're going to build it out in that additional income section. Next is financing the asset. We work closely with our mortgage banking team to make sure that we are modeling the assumptions for the financing correctly. And then we'll model the sale of the asset. And that's made up of hold period assumption, which is typically going to be somewhere in between 3 and 5 years, and the exit price, which is derived from a market cap rate and our NOI at sale of the property. Once we've done all that, we can identify what price we would like to offer on the asset. And that is just a product of the pro forma, or the, call it projections, that we're building out for the next 5 years, and what we think we can sell the property for. And then ultimately we're just backing into a price based on what we think we can pay in order to return good returns to our investors. Here I've put in a screenshot from our model. You can see a lot of the metrics that we look at. DSCR, so making sure that we're able to cover the mortgage, the debt service at the property, our cash on cash, a lot of those metrics that really help us figure out if we're in a good position underwriting this deal. Here you have our 5-year pro forma. You can see that we have our T12, which means over the past trailing 12 months, how is the property operating under the previous owner. We have our at-close underwriting. You can see here that there are some differences in line items, like payroll here for the previous owner was only $1,400 a unit. We thought that was too light, so we wanted to make sure the property was properly staffed. So we raised it to 1,600 units. So little things like that. And then over the next 5 years, how do we think the expenses are going to change? So we make sure that we increase expenses every year with inflation, but we also grow rents as the market can support it. That's our next operating 5-year budget. And the supporting data that we reference when we underwrite is super important. One of the most important things that we look at are the rent comps in the surrounding area. We always like to track where our rents are going to fall compared to the other assets in the area, because ultimately, if we push our rents too high and the tenant can go get a similar living experience of the property next door, they're just going to move out. We're going to be left with a lot of vacancy. So we need to make sure that our rents are always in line or below the comparable assets nearby. Sale comps within the surrounding area. We have a lot of great data aggregation services that we use. And one of the things that those data aggregation services tell us are the sale prices of similar assets in the area. We always like to figure out, how does our purchase price stack up to past trades in the area? That really gives us a good idea on, are we getting a great deal or are we way overpaying for this asset? And we also like to compare our exit price to the historical trades. Neighborhood scout reports. This tells us a lot about how's the crime in the area. We want to make sure that we're buying assets in good areas. And is the property in a good school district? Ultimately, a lot of the tenants at our properties are families, so we want to make sure that we're buying properties that are both in low crime areas and are in good school districts where families want to live. We like to track the incoming supply in the surrounding areas. Over the next 3 to 5 years, how many new units are going to be built? Every new unit that comes online is just another vacancy in the market, unless you have what we're going to discuss next, the forecasted absorption. So these are the amount of people that are moving into the area. Typically, we like to see that absorption is going to outpace the new supply. It's just supply demand. If we have a lot of apartments and there aren't a lot of people who want them, your prices are going to fall. But the inverse is, if we have a lot of people who are looking for places to live and there aren't as many places to live, the price for rent is going to increase naturally and your vacancy is going to be low. The other thing we like to look at is economic drivers in the area. Is Amazon building a new warehouse just down the road? And how many jobs is that going to create? And how many people are going to have to move to this area and need places to stay based on that? And also based on that, we like to see, is it blue-collar jobs that are being introduced in the area? Is it white-collar jobs? And really that gives us a good idea on what people are going to be able to pay for rents. Here you have a screenshot from our model on the rent comps tab. You can see on the far left is our subject property and what the rents are going to be before our renovation process and then after, and how that compares to other assets in the market that we have deemed comparable. We like to see our post-renovation rents fall in line or below the comp. Here's the sales comps table that I was referring to earlier. You can see our acquisition is here in blue, and then our disposition, our sale, is here in blue over on the right. So you can see that we're obviously buying this deal at a very great basis. There are a lot of deals that we have considered comparable in the area that have sold for a lot more. And one thing we like to track is, when did it sell? Obviously, there are ups and downs in the markets. In 2021, we saw one of the highest highs for valuations that we've ever seen in real estate. For that reason, we don't like to look at deals that sold in 2021 because they're not necessarily applicable to the current market we're in. So we always like to make sure that we have sales in 2024 or 2025, that those are going to be more applicable to what we're buying today. On the far right, you can see that our disposition is higher than any historical trades in the area, but it's not a ton higher. That's something that may be a little bit of a cause for concern because nothing has ever traded that high, but it's just going to be something that we monitor and make sure that we feel completely comfortable with before we move forward with the deal. Bidding process is the first thing we do after we've come to a decision on how much we're willing to pay for the asset. First is initial offers, and this is what most brokerages call a call for offers date. They'll give a call for offers date. Hey, August 5th, we need all of the offers in from any of the groups who are going to bid on this deal. Most deals really only receive 10 to 30 offers, depending on how popular its marketing process was. From those initial offers, the brokerage and seller team together will decide to move forward with what's called best and final offers, where they choose 3 to 8 groups generally that they want to give a second chance. They say, hey, we're inviting you to the best and final offers. Here's a new rent roll, here's a new T12, update your underwriting and see if you can push on pricing at all. Sometimes groups will say, okay, we made it to best and final. We really want this deal. We're gonna push up our pricing $500,000. Sometimes groups say, we're completely tapped out. Our first offer was the best offer we have. They'll also conduct buyer interviews. This is when you meet with the seller team and you basically tell them why you're the correct buyer for the deal, how you're going to get the equity, how you're going to get the debt, why you think you're the right guy to buy this deal and why they should choose you. And then based on pricing and the buyer interviews, the deal is awarded. The seller selects a group to move forward with selling the deal. And it's important to note that it's not always just the highest offer. There are a lot of things that go into whether or not a seller chooses a certain group over another. Currently, the market is in a position where not all trades are going through. Sellers want to make sure that they're choosing someone who is always going to be true to what they say, not change the terms, and close in a timely manner. As we discuss about the bidding process, I should give you a little color on the letter of intent and the purchase and sale agreement. As we're sending in offers for the bidding process, we're using a letter of intent, what most people just call an LOI. This is used as the framework for the PSA. In the LOI, you detail the pricing, what you think your closing timeline is going to be, the earnest money that you intend to deposit, and any other terms that are applicable to the deal. It's legally non-binding, and it's really just used as a way to tell the seller what the terms are that you're offering. Once they accept your LOI, then you move into a PSA, or a purchase and sale agreement. This details every minutia, every single aspect of the sale process. Your reps and warranties, which are basically what the seller is telling you, hey, all of this information, the rent roll, the T12 I'm giving you, I'm confirming that it is all accurate data, and if you find that it's not accurate data, here are the warranties that I'm willing to give to you if that happens. This is a legally binding document. It outlines the due diligence period, which is the inspection period of the property, the closing period, and any extensions to either the due diligence or closing period. Your earnest money, which is basically how much money you put down initially as what I would consider an act of good faith that, hey, I'm gonna close this deal, although I'm not gonna put down the full $60 million purchase price day one. I'm gonna give you $250,000 just as an act of good faith of letting you know I intend to close this deal. And then seller deliverables, what all they have to deliver to us, the rent roll, the T12, the rentable items, surveys, stuff like that, and the timing of the sale. Securing financing. One of the big things as we underwrite is what kind of financing are we going to go with? Agency loans. Those are made by Freddie Mac and Fannie Mae, which are government subsidized lending agencies for affordable housing. Or are we going to go with bank or bridge loans? Typically, you're going to find better pricing with agency loans, but their aggressiveness as far as leverage is going to be lower, so you're going to have to bring more equity to the table. Bank and bridge loans are typically priced higher in terms of interest rate, but they are going to be higher leverage as well, so you have to bring less equity to the closing table. Next, you have to figure out, are you going to go with fixed or floating rate debt? So what fixed rate debt is, as soon as you close the loan, that is going to be your interest rate for the rest of the loan period. So the way that a fixed rate interest rate is derived is you take the 10-year treasury or 5-year treasury, whatever kind of loan it is, and you can see I took a screenshot here of the treasury over the last, it looks like 4 years. You can see how it's moved up and down. Right here, if you took out a fixed rate loan, your rate is going to be really low. But right here, if you took out a loan, it's going to be higher. Taking out a fixed rate loan is definitely the most risk adverse thing you can do. If the deal works at a higher interest rate, there's really no reason to not take out a fixed rate loan, just to know that we're comfortable here. If rates go higher, we're gonna feel good that we fixed our rate here. If rates go lower, we know the deal works at a higher interest rate, so we're comfortable where we are. Floating rate loans, it's based off SOFR and then a spread. SOFR, which is the Secured Overnight Financing Rate, which is a rate that changes every day. And then what's called a spread that the banks or bridge loan providers determine. So if SOFR was, let's just say right here, it's 4.1%. And then the bank applies a spread of 3%, you're going to be paying 7.1% on your interest rate. One way to make sure that you don't get burned on floating rate debt is you can buy what's called an interest rate cap. Let's say you buy an interest rate cap at 6%. That means that if SOFR goes to 7%, you're still only going to be paying interest on the 6% SOFR plus whatever the spread is that the bank put forward. There are really two different ways to buy interest rate caps. One's called an in-the-money interest rate cap, which means day one, if SOFR is at 5%, I'm gonna buy an in-the-money interest rate cap at, let's just say 3%. So day one, my interest rate is capped at 3%, so I'm paying 3% plus that 3% spread. So a 6% interest rate instead of the original 8% that I talked about. That's gonna cost a good amount of money buying that interest rate cap because you're already experiencing savings on it day one. You can also buy a cheaper interest rate cap, which is called an out-of-the-money cap, which is basically a hedge against rising interest rates. So that's what I talked about earlier. If interest rates are 5% today, we're gonna buy an out-of-the-money cap at 6% just to make sure that our interest rate never goes above that 6% SOFR amount plus the 3% spread. So there are pros and cons to both. It's really just something that you need to figure out internally what risk you're willing to take and making sure that you have a lot of risk mitigation, because there are a lot of groups who took out floating rate debt in 2021 when rates were super low and we never thought they were going to go higher. And now they're really experiencing some trouble because their interest rates have tripled in some cases. So that's just something we want to make sure that we definitely focus on a lot. Next is raising equity. We'll put together a package that basically details all of the aspects of the deal, and we'll go out and pitch some groups. Here we have 3650 Capital, Berkshire, Pennybacker, Mosaic, all groups that we've worked with in the past. So basically we just go to them and we present the deal to them, we pitch them, tell them why we think that they should invest their money with us, and based on that, they decide yes or no. After we've done that, we do the property due diligence, which is where we go on site and we make sure that everything of the property is how we envisioned it. All of our teams come out for due diligence. The first is property management. And everybody has their own role during due diligence, and property management's role is walking 100% of the units, the common areas, and the amenities, and making sure that everything's in good shape and how we envisioned it. They do 100% lease file audit and utility audit, which basically means looking at the leases and making sure that the rents being paid on the rent roll are the same as the leases, and the move-in dates and move-out dates, just making sure that everything's trued up. And a utility audit, which is looking at the utility bills and making sure they are the same as we saw on the T12. They're also in charge of all of the website, leasing software, social media, domain exchange, stuff that goes on at the property. Next is RREAF Construction Services. So they're gonna help us identify the scope for the renovations on the units, the common areas, and the amenities. They're gonna help us identify any deferred maintenance or fire safety, immediate repairs that we need. They're gonna help us figure out, hey, are these roofs aging? Do we need to adjust our budget to reflect that we're gonna have to replace these roofs at some point during our hold period? Based on all of that, they're gonna put together a detailed interior and exterior renovation budget. And it's important to mention that when we initially underwrite a deal, we typically budget for what we consider worst case scenario on what we find at the property. Is it gonna need a lot of repairs? Is it gonna need a little? It's all about just adjusting our budgets accordingly based on our findings during due diligence. And we have our third-party reports where we get appraisals, property condition reports, environmental site assessments, all of that. And a title review, which basically means, is there any kind of ownership debates over the property lines? Because sometimes you'll look back at surveys and the property owner thinks that they own this, but if you look at the next property's survey, they think that they own, 5/10 of an acre that you thought you owned. So just making sure that all of the property lines and are correct and there's no, disputes over ownership. And like I mentioned, we're going to modify our underwriting and business plan to align with our findings throughout due diligence. And finally, we've made it to closing. We are going to make sure that we do any prorations for the property, which means, let's just say that our closing is set for June 15, 2026. We want to make sure that all of the income for the property is prorated appropriately between the seller and us, the buyer. On income, we think, okay, we're closing on the 15th, which is directly the middle of the month. So we want to make sure that half of the rents that have been collected by the seller are staying with the seller, but then we're also entitled to the second half of the month's rent. So we want to make sure that we get that. I said we closed the deal in June, so taxes. They may have already paid the taxes, they may have not. So we just want to make sure that we're only subject to the second part of the year's taxes and the seller pays the prior month's taxes. Any security deposits need to be dispersed correctly. The service contract, so if our pool cleaner came and they already paid them, we want to make sure if it's a monthly charge that we're splitting that up correctly. Any rent ready credits, which basically means if we go through a unit during due diligence and it is not ready to be rented to a new tenant, we're going to be subject to a rent ready credit of maybe $2,000 or $3,000. That'll be laid out in the PSA. Next is the wiring of funds. Our debt provider and our equity provider will all wire the funds to the title company. And once the title company has collected all the funds and made sure that everything for the closing is correct, they will then disperse the funds to the necessary parties. And at that point, you have a transfer of ownership. You've closed the deal. And finally, once the deal is closed and we're the owners of the property, our management will step in and the property is ours, and we are going to spend the next 3 to 5 years implementing our business plan and creating great returns for our investors. And that is the overview of the multifamily acquisition process. Thank you all for listening, and I hope you all learned a lot today. That concludes this session of RREAF Academy. While we've only scratched the surface of the acquisitions process, I hope this gave you a solid foundation for understanding the thought and consideration that goes into evaluating each investment opportunity here at RREAF. If you have any questions, want to explore any of these topics further, please feel free to reach out. And those watching online, don't forget to check out the rest of the RREAF Academy series for more in-depth insights. Thank you for tuning in, and see you soon.